Hey everyone, in this video I'm going to compare and answer which stock is the better buy. Is it ChargePoint, ticker symbol CHPT stock, or is it Canoo, ticker symbol GOEV, GOEV stock? Which one of those is the better stock to buy? I'm going to look at some financial metrics to compare and then look at valuation and finally answer which one is the better stock to buy. Let's get started with revenue. I like getting started with this one, revenue, because it really highlights the big difference here. ChargePoint, with 130 million in revenue in its most recent quarter, has been growing rapidly over the last 3 years. Meanwhile, Canoo, barely registering on the tape here, 2.55 million in revenue in its most recent quarter. Very few sales logged in. It's really hasn't started ramping up production just yet. The third quarter, the one that's upcoming, is going to be the big one for Canoo. That's when it's promised that revenue will start to increase, it will start to make deliveries, and it will start to increase production. So Canoo this whole time has been primarily a research and development phases, going through finding iterations, demonstrating its product to companies that could potentially order its products. It secured a major deal with Walmart for its delivery vans, its electric delivery vans. So that was a big update. Now, hopefully, it can continue and it can deliver on that. But as of yet, it's not in the significant stages where it's producing, delivering, making sales. So, with that regard, I wanted to look at cash flow from operations. How much cash is the company's going through if they're not generating revenue in Canoo's case, and for ChargePoint, is it actually generating cash flow off of those sales? So, interestingly, ChargePoint, as it makes more sales, it's just losing more money. It's just losing a lot more cash. Look at its cash flow from operations, falling from negative 40 million all the way down to negative 104 million, its worst quarter ever, despite the fact that its revenue has been growing, right? You look at that revenue chart, it's been growing. Regardless, its cash flow from operations has been going in the opposite direction. Now, hopefully, it can turn that around, but there's no sign of that just yet. Canoo, meanwhile, it also has been burning through cash. Of course, with limited sales, you wouldn't expect anything different. But it actually started reducing its cash burn, notably because it probably noticed that it can't continue at this pace. It's going to run out of money. So it reduced the cash burn, losing 67 million in its most recent quarter. When the company starts making sales, it's still not, to be sure, going to reduce this cash flow from operations negative. It might actually worsen before it gets better. That remains to be seen. Regardless, each of these two stocks very risky because they have such negative cash flow from operations. They are not self-sustaining. They need to continue going to public capital markets to borrow money to sell more stock to raise cash just to sustain themselves. And if that's what they're doing, then the next thing I want to look at is the average diluted shares outstanding. How many shares outstanding there are, because as more shares go into the market, as the company sells more stock to raise cash, that dilutes shareholders. Meaning if you owned a share of stock 3 years ago, that share is worth much less today. It owns a smaller percentage of the company because the company issued more shares, right? Think of it this way. If you had one share and the company had a total of 10 shares outstanding, you owned 10% of the company. So if or when it became profitable, 10% of those profits would be yours. But if the company issued more shares and now there's 100 shares outstanding and you still own that one share, now you own just 1% of the company. And if or when it becomes profitable, only 1% of those profits would be entitled to you. So that's why average shares outstanding is important. And it's something that companies that are losing a lot of money on the bottom line, unfortunately, have to do. And you can see Canoo here going from about 100 million shares outstanding all the way up to 418 million in the last 3 years. So shares outstanding have quadrupled, more than quadrupled for Canoo, and I suspect this will continue to be the case. I suspect more shareholder dilution is on the way for Canoo. Same thing for ChargePoint, although not as severe. Shares outstanding rising from around 260 million up to 350 million for ChargePoint. So there is shareholder dilution, but not as severe as Canoo. So let's look at cash, how much cash they have to tell us if or when there needs to be more stock sold. And for ChargePoint, it's got some runway, right? It's got 283 million in cash, but Canoo only had 6.7 million in cash as of its latest quarter. So sometime it needs to raise cash. It can't, at the pace it was losing money, it can't continue. It will run out of money if it only has $6.7 million of cash out on hand. So Canoo's in a precarious situation, needs to raise more capital, and it's unfortunately not going to be on favorable terms unless something dramatic happens over the next month or so. So finally, let's look at valuation. And unsurprisingly, ChargePoint stock is way more expensive than Canoo, trading at a forward price to sales of 2.5 compared to Canoo trading at a forward price to sales of 0.192. Of course, investors are concerned with Canoo's financial situation, so they're not willing to pay as high a price for its stock. And I echoed that opinion. If I had to pick one of these two stocks to buy today, I would pick ChargePoint stock to buy today. It's the less risky of the two, and risk is a major area of concern when you have such companies with such huge losses on the bottom line every quarter. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.